bubbles are easy to predict, hard to time. Our industry does a really good job of trying to confuse people. At the end of the day, you really only have 5 places to invest: stocks, bonds, real estate, cash, and commodities. Where I think you run into risks, where you run into issues, is when you're trying to out-trick one of those 5. I'd first look to see what your indirect exposure is through how you're already expressing your views before you take specific bets on these opportunities.
You got the dot-com crash, you got 9/11, you got COVID, you got the Great Recession. All of these are economic cycles, and all of these are points where the markets fell apart. But then let's add one more, the Bear Stearns crash. This is what you've been through. You were part of Bear Stearns when they were going down in flames. How did you go from all of this chaos to where you're at now, managing over $1.3 billion? Do tell.
Yeah, it's bloody knuckles a long way for sure. White knuckles through planes. And in fact, I'll tell you a little story. I was landing in Hong Kong. The Friday, Bear Stearns was given the lifeline from JP Morgan to help make its way through the weekend. And then on that Sunday being purchased for initially $2 a share, which they ultimately renegotiated at $10 a share. So how you do it, you you kind of trust the system that it's not going to completely fail you. And there have been treatises written along the way in our careers that say, hey, listen, we're in the middle of what seems to be the worst moment in time, whether it be COVID, whether it be the credit crisis, whether it be being attacked in New York City, or the dot-com bubble. And there is a certain amount of faith that one needs to put into the system. And that's at our core.
I love that. I love that. You know, I've been in the industry since 2003, not quite as long as you, but you know, we've both gone through some of these cycles and these major recessions, which literally, I'm sure you would say the same, brings you straight to your knees. And I didn't think we were going to make it through it. I didn't think I was going to make it through it as a person and as an advisor, but it makes you stronger and it helps you prepare for what's next. And I think you've used that really well. You know, being chief investment officer and CEO of your firm, One Wealth. But, you know, I really want to kind of talk about the journey. You know, we both are in the industry, in this industry, and folks, you can all look this up, is one of the most difficult industries to make it. The average success rate of an advisor is probably that of maybe 10%. So think about that. In a room of 100 people, only 10 will make it. And out of those 10, the 10 that make it might not make the long haul. You know, so it's literally a business of that almost you're destined to fail at, but a few survive. And that's really what I want to talk about, is that path to succeeding in one of the hardest industries, because there's a lot of pain and suffering that goes on, and a lot of it is self-inflicted. But on the other side of that is just a glorious, you know, it's just glorious. It really is.
It is.
I know your story is probably very similar, but maybe even more severe because of when you started. You know, being 1997, you had a lot of clients, probably money under management, being at Bear Stearns, cold calling, because that's just how you did it back then. Pound the phones, pond scum. You guys have seen the movies, Boiler Room, Wolf of Wall Street and all that. But like, that's real. That's as real as it gets. So talk a little bit about those early days and what it was like. Because you were a cook in the prior, and then how did you make it into the financial world?
Yeah. And so it actually, interesting, the Wolf of Wall Street story is applicable here because my brother, who's my partner, started in the business in 1991 and did navigate his way through types of businesses like that, where he was working, and realized in around 1996 or 1997 that he wasn't necessarily providing the best service to society, and had what he calls his Jerry Maguire moment. And in 1997, I had graduated with a degree in business from Temple University, but was cooking full time through my time in school, and thought I wanted to pursue that as a career. And my brother had just moved to San Francisco in 1997. I had just graduated, and back then I went to Temple University, which is in Philly, and back then to make it as a cook and to become a chef. You're either moving to San Francisco or New York. Philadelphia is a good restaurant city now, but back then it was either San Francisco or New York. And so I pursued a career as a cook, and in about 10 months realized that cooking was a really good job through college, but not a great career path for me. And my brother had just gotten a job at Bear Stearns at that time, starting to pursue what he felt was a much better path to provide his abilities in society. And he basically said to me, "Hey, listen, like I can get you an interview at Bear. I don't know if it's going to amount to anything." So I interviewed at Bear and quit cooking. And shortly after selling Christmas ornaments through seasonal work, started cold calling in December of 1997 at Bear. So that's kind of the transition from cooking to my time cold calling.
You're literally just cold calling people. What was that like? Like, because you got to have
It's the
thick
best.
skin.
It was the best, honestly, because so many people ask, how could you have liked cold calling? And here's the only way I could explain it. When I woke up every day and walked into my job as a cook, it was doing the same exact thing. We have this concept of cooking, this concept of mise en place, where you walk in, you get your vegetables out, you get all the stuff out that you're going to cook for the day. It's rinse and repeat every day. You finish, you wrap up, do the same thing over and over again. It was a nightmare for me doing that. But when moving to cold calling, very similar concept, $500 a day. You walk in every day, but you're sitting in like a warm place in front of a computer in an office. I felt like I was the man, honestly, because I walked in with the one suit that I had. It was a double-breasted pinstripe polo suit, which was ridiculous as my first suit in my job. But I walked in thinking I was literally the cream of the crop, and had my physical phone there and made $500 a day. And we had this concept, 110-5, which is basically if you can make 100 dials, you're going to get 10 contacts and you're going to get 5 qualified leads out of that. So multiply that, 500 dials. I got 50 contacts a day. I got 5 qualified leads, rinse and repeat. And it sounds like a very aggressive form of marketing, and it was. But here's the transition that took place. When my brother was doing this kind of work in more of a like an aggressive sales process in the early 90s, he was pitching stocks, right? And he was pitching large cap stocks, small cap stocks, whatever it was. But he had the vision to say, hey, I can take this, and we could take this quasi aggressive form of marketing by cold calling. But instead of pitching a stock, we're simply pitching a service. And the pitch was simply, are you willing to sit down and talk to us about financial planning? Right. And if so, are you working with anybody else who's working, who you're working with in that same vein? Our qualification process was, if they're already working with a financial planner, we don't need to work with them because they're probably being served well. And so basically I would hang up, cross that person off. But enough people said, no, I'm really talking to somebody and they're pitching stocks to me. Those were great opportunities for us. So if you can get a list of enough people that were willing to sit down with you and not working with a financial planner, we would take, 10 meetings, 12 meetings a week. I would be making $500 a day, get 50 contacts, 5 qualified leads, build our system. And then that's basically how we started our practice.
You said something interesting. The other day, I had a guest on this podcast, Mona. Mona's been in the business longer than you and I, but she was basically working in NASDAQ, bringing companies to IPO. And we were talking about like her whole journey. And one of the things she said, and it's very relevant to you, there was a switch. And I think it's right what you were just talking about, where the advisory world, it wasn't the advisory world, it's the stockbroker world. You started as a stockbroker selling stocks. Yep. And a unique thing, and I remember this because I used to get these calls. I used to buy a stock from this broker, that broker. I feel like some of the stocks that were being pitched were actually really, really good opportunities that today, those opportunities don't come to the average retail investor because the stockbroker days are dead. And you saw that transition, how you start selling a service, financial planning, and all these things, which is kind of been now the whole industry has shifted to that, where now it's all AUM and advisory services, fiduciaries. But what are your thoughts around what Mona said? She said the big thing we've lost is that ability to have access to these amazing companies in those early stages where there's really lots of growth for these companies. Where today, you really look at it, you got the indexes, you got the S&P 500, which is largely dominated by seven, predominant tech stocks. And the average person, the average investor with 401ks doesn't have access to those stocks you used to call and pitch 500 times a day. Like, what are your
Yeah.
thoughts to that? I thought it was a really unique perspective to the industry.
It is. I feel there are still probably diamonds in the rough that are publicly traded. There's an entire movement to extend your life as a private company longer. And so depending on the qualification of the type of client that you have, there has been the democratization of accessing private companies along the way, which I find to be a double-edged sword, because the asymmetric information that's provided around these companies, I think is not necessarily maybe in the investor's best interest without being guided properly. So you have the diamonds in the rough with respect to the publicly traded markets. I think there are enough publicly traded stocks out there, although I believe, if I'm not mistaken, that we're almost cut in half with respect to the amount of stocks that
it's exactly half, actually. It's funny.
Yeah, it's from 97 to this day. And so, yes, I do acknowledge that that the access to those smaller companies and companies that are off the radar are there are less of them, but I think they're still out there, right? And so if you as an investor want to pursue a smaller company, or a company that maybe has less information out there as a public company, you can do that. But to me, the bigger opportunity for a larger set of investors is the private markets. And obviously this is dependent on your accreditation, so you need to be careful around that. But nonetheless, companies are staying private for longer. And as a result, there have been technology companies and services that have come in to help investors access those private markets.
So let me get a little tactical here. With One Wealth, your firm, you guys manage about 1.3 billion. Is that correct?
That's correct.
Okay, so that's a big registered investment advisory by all accounts, and you guys have earned everything that you've gotten. But you've seen a lot of changes in the industry because of how long you guys have been around. And one of the things I really kind of want to talk about is where we're at. This is a pretty unique time, a very unique time in history, because it's the longest bull run in history. And when I'm a studier of history and these cycles, and when I think about where we're at and I look at all the things that are happening, the only thing that comes to my mind are two things. Number one, the dot-com crash. Before that, I feel like it's very similar to the AI boom we're in right now, boom and then bust cycle. But then when you go back to pre-1929, the roaring 20s, where, you just had everybody making wealth and building wealth with stocks. And then all of a sudden, just one day, it's just all over. Like, I can't help but to study those two things and think that this looks a lot like where we're at today. The average 38 years old or younger, I think it might be 39 now, has never really felt the impact of a recession or any downturn in the market. So they really have this ultimate confidence that everything's just going to go up and up and up. And the Fed and the government are just going to save the markets every time they start to hemorrhage. But you and I both know that there's cycles, very defined cycles, and doesn't matter what the Fed or the government can do, those cycles have to play out. The longer you keep those cycles going through, monetary action, everything else, the bigger the bubble gets. And we talked offline right before we started, and you said you think we're like toward the tail end of this cycle. But explain to this audience, and this audience is a very in tune, mostly accredited investors, where do you think we're going, and what plays out with this cycle, and how much longer can it push?
Yeah,
I know you can't time the market. I get it.
History rhymes. And so, yes, I believe you're right that we could experience something similar to the late 20s or the dot-com crash. It would be hard for me to predict when that's going to happen. In fact, if you look at Case Shiller, and Shiller became famous around the dot-com era, right? And so if your listeners are in tune to looking at history and those who have tried to predict bubbles, Shiller was writing about bubbles in the mid to late 90s, well before it happened. And so So bubbles are how I understand it, as it has been written, bubbles are easy to predict, hard to time, right? And so where are we in a bubble? I'm not 100% sure. Typically, bubbles burst largely because of leverage more than anything else. Interesting, we have an extraordinary amount of cash on the sidelines. I think it's $7 or $8 trillion as it's represented. As it's related to the value of the stock market, it's a lot lower than it was during times of bubbles bursting. Nonetheless, I do feel like we're over the next couple of years in for a bit of a rocky road. But like I said, it's very hard for me to know where that bubble is going to burst and what's going to make the entire market become unsettled.
Yeah, and I think one of the best case studies, if you will, of like trying to time the market is Ray Dalio, one of the most famous hedge fund managers with Bridgewater. He thought he had it right. He was sure he had it right, and he almost lost everything trying to time the market. You can't time the market, but you definitely have to be observant of the market. Now, Jonathan, one thing too with your firm, I know financial advisors, one of the biggest job a financial advisor has is risk mitigation for their clients, making sure that their clients are protected and that their goals and needs will play out regardless of what cycle or what happens economically. But I talk to a lot of advisors, okay, and I meet with a lot of them, and a lot of them literally have this very optimistic view of everything where it's just going to keep rolling and keep going. And I almost feel like it's a lost art of risk mitigation, of actually planning for that day, because it's so easy right now just to pick winners. You put them in the S&P 500, put them in NASDAQ, and for the most part they've all won. And I hear it all the time. Oh, my 401k went up 28%. And I'm like, I always tell them the same thing. I always say, okay, I got a challenge for you. Keep it. How are you going to keep it? And I think that's the biggest job advisors have. So what do you, from you and your brother, because I know you're in business with your brother at One Wealth, what do you guys do to manage risk?
Yeah, so we're religious about referring back to a financial plan as we invest clients' money. And we review on a regular basis the allocation that is recommended in that financial plan relative to how the clients are being invested. So that's goals-based investing. I think any listener on your podcast should be focused on goals-based investing, which basically means identify why you're investing, create a set of rules around the types of investments that you're making to meet those goals and objectives, and revisit it regularly. And I think our industry does a really good job of trying to confuse people. And at the end of the day, you really only have 5 places to invest: stocks, bonds, real estate, cash, and commodities, right? And so if I think about those 5 places, there's flavors of all of them. So where I think you run into risks, where you run into issues, is when you're trying to out-trick one of those 5, meaning that, okay, let's say your goals-based plan says you should have 40% in bonds. But bonds for the last 10 years have been essentially earning you nothing, right? Up until recently. So what do? You try to extend out the risk associated with the safest part of your portfolio to incrementally increase your yield, right? Where I think advisors and investors can get in trouble is that if they overextend in any particular asset class or take more risk than that asset class is deserving of. And as a result, if, for instance, your bond portfolio based on your goals-based investing profile should have been 50%, but you've put 40% of that in high yield, which is our bonds, because high yield was giving you, 5% when bonds were giving you 0, I think you're going to get in trouble. So be careful about how you invest in those 5 different asset classes. It's okay, in my opinion, to take a portion of each of those asset classes and carve out a little bit of risk in each one of those asset classes, but remember what the reason is for each of those 5, and make sure you're trying to stay as true as possible to those 5.
Your real estate business lives and dies by the network and the connections that you make. I mean, after all, your network, well, it's your net worth. That's what you always heard, right? If that's an area where you desire improvement, well, Private Money Club, it's for you. PMC saves you precious time and money by bringing the real estate world, well, right to you, right in the palm of your hand. So get in on the action like so many others have by going to privatemoneyclub.com and sign up.
I love that. Let's move into like the hot topics for today, because we're sitting here
Sure.
February 2026 and all the rage, maybe not this week, but all the rage has been precious metals. And, it's everywhere. You can't ignore it, gold and silver and all the precious metals. And also let's throw Bitcoin in there as well. Those different investments have been on a pretty crazy tear. And while Bitcoin's definitely hemorrhaging quite a bit now, sitting, I believe this morning was at 67,000, down from the highs of 120. Like, how do you look at those asset classes when a client of yours calls and says, oh, we got to get into gold just because it's going up? People love to hitch on to the winners, but they really should be looking at the losers as the opportunities. What is your take on those topics?
So I don't consider metals and commodities in general related to Bitcoin. So I think you have to separate those two things.
And there's a lot of people that do. I'm glad you said
Listen,
that. A lot of people look at like Bitcoin and metals as a store of wealth, and they almost make them an equal. Not at all.
Yeah. Okay. So that aside, so stocks, bonds, real estate, cash, commodities. We're talking about commodities now. So you have different types of commodities. You have precious metals, you have industrial metals, right? Then you have agriculture and other types of commodities. So in my opinion, if you were going to make a decision to invest in that fifth asset class, which is commodities, consider doing it broad-based, right? So consider both industrial and precious metals, consider agriculture, all those things. So maybe take a core position in a broad-based commodity fund, for instance, if you feel like a portion of that portfolio based on your goals is deserving of commodities in the portfolio. And then, like I said, if you want to incrementally take some risk and or look for opportunity in any portion of that asset class, then take a little bit and put it into something that is a bet for you, right? And so stocks, bonds, real estate, cash, commodities, core commodities allocation, and then maybe take a percentage of that and put it into gold because you feel as an advisor, you feel as an investor that you want to take a swing for the fences, for instance. And if you did in gold, God bless you, because if you did it, maybe a year or two ago, then you're looking pretty good. When clients reach out to us and say, hey, do we have any commodities exposure, or do we have any Bitcoin exposure or crypto exposure? We'll typically look to the broad portfolio that we've built for them to see what type of indirect exposure that they have before we talk about specifics, right? And so we did this study a couple of years ago when clients were asking about how much, do we have any Bitcoin? Our general mindset when we looked into how we were expressing our equity exposure in many of our clients' portfolios was that they indirectly had between 2 to 3% in crypto, because they had indexes, and those indexes were largely driven by 7 to 8 companies, right? Which were NVIDIA and the others that had indirect exposure to crypto, or artificial intelligence could be an example of that as well. So I'd first look to see what your indirect exposure is through how you're already expressing your views before you take specific bets on these opportunities.
Man, that was well said. All right, let's talk about one of the other asset classes, good old fashioned cash. So yeah. You look at Warren Buffett, and it's really hard to ignore anything Warren Buffett does, because arguably one of the greatest stock, investors of all time, or with the exception of Nancy Pelosi, because she is the all reigning king of stock picking. I'm not going to go there, but Warren Buffett, fundamental investor, old school, great principles, follows his rules to a T. And the guy is sitting, and I don't know where it's at today, but probably just shy of $400 billion in cash. Mm-hmm. And if you look at his history, he's never been a cash guy, never sat in cash, maybe some T-bills and treasuries, but never cash. But here he is, which should give a signal that he's either waiting for the opportunity to come to him, or maybe there's a fundamental shift in how he's looking at investing. What is your take on cash in today's environment?
Well, I think about cash like any other investment, right? There's a trade-off between risk and return. Cash right now, if you consider money markets as cash, and sure, be very, very mindful of how money markets are invested. I would say that if for your listeners, they should be performing due diligence on money markets in the same way that they're performing due diligence on their other investments.
2008 should have taught us all that.
Yes, exactly. And by the way, that fund did return 99.99% of its money. It just took some time to do so. So that you're talking about the fund that broke the buck. It was prices at $1. Yes. But yes. So illiquidity of that and the risk associated with the money markets, potential money markets aside, you're earning probably 3 to 4% on your quote unquote cash right now. So Warren Buffett is saying my opportunity set is I have these investments, right? He has a ton of investments still. He's levered. Those investments have inherent leverage because the businesses that he invests in have leverage. So even though Berkshire Hathaway isn't necessarily borrowing money to purchase these companies have inherent leverage, right? And to offset that, where we are in the economic cycle, he probably said, I can place my money in treasuries, I could place my money in corporates or munis, or I could just simply park it in cash, which is earning me 3 to 4% right now. So in my opinion, my sense is that Warren Buffett is not saying I want to stay in cash because I'm scared of the market because he has a ton invested still. He's saying I can make 3 to 4% on my money in something that I know I can get back at a moment's notice. So that's my mindset around him parking cash. Well, and by the way, we feel the same way.
I love this topic, and we're going to go one layer deeper for the audience. So when we talk about cash and what you just said, that is the exact same sentiment as I feel right now. And I have probably way too much money in treasuries and T-bills right now. And it's for the exact same reason.
For you or for your clients?
Just for me personally. I'm not even talking about our clients. I'm not licensed anymore. So in 2018, my wife and I got a show on HGTV. Our compliance officer said, we're not going to approve the OBA. So I sold my practice then. And most of what I do today is the infinite banking concept and privatized banking. My holding company owns our RIA, but I do not run it. Stefan, our COO, runs that. But so I'm not licensed. I don't give investment advice. I'm just talking about my own personal money in our hedge fund that we have for our family. So I love what you just said because it is so true. I mean, very few other times in history you can look where you get paid a very good premium to sit on the sidelines. I think of it as a game, right? Like you're the top quarterback in the league. You're paid tens of millions of dollars a year or more. And, the coach just says, hey, I'm going to have you sit on the sideline because, well, it's just a better risk for us to have you sit there. That player's not upset in most cases. And that's kind of where I'm at. You get paid so well for sitting on the sidelines right now. It's hard to ignore that. And I think that's what you mentioned with Warren. And that's what you said you guys are looking at. But it also positions you in an opportune place because now when something does happen, and it will, it's just when is the question, you literally immediately are in a very nimble position where you can take advantage of the opportunities. But with treasuries, this is where I want to go a layer deeper. I also understand very well because when I took the Series 7, that was the majority of that test. And I never forgot it because you drill it in your mind, that inverse relationship between price and yield. And I think we're in a just unique period of time where you can almost predict Fed action. You can almost see now with the Trump administration, Powell's replacement, they're going to continue to bring rates down. And as they bring rates down, if you just look at history and you just follow the general rules, price of these long duration treasuries, which are paying really amazing yields, is, historically going to go up. So like for me, I look at it like, why would I take risk? Why would I buy risk on assets when I believe in fundamental investing and fundamentals are kind of out the window right now, when I can get paid to sit on the sidelines in these boring treasury bonds, get a good yield, but also know that I'm going to see some price movement on the upside that is pretty darn easy to predict. What are your thoughts around that? Now, I'm not saying everybody should rush out. This isn't investment advice, but this is just what I'm doing and what my belief is.
Yeah, well, same here. I mean, on a podcast, I'm not giving investment advice for specifics, right? This is kind of my general belief system and things that we think about for our clients. But what I would say is that Silicon Valley Bank had the same mindset with respect to long duration assets and the mismatch between long duration and short duration. What I mean by that is if you have needs for your daily lifestyle, or if you have needs with respect to how you're trying to invest as it relates to a long-term plan, and you purchase long duration assets, but you need money short-term more, and you need the liquidity to access that money, I would say that you want to be careful that in the event that you're wrong, meaning that rates do go up, which is essentially what happened to Silicon Valley Bank and others. And long-term capital in the 90s. You're a history buff. This basically long-term capital is deploying a very similar concept, but highly levered. When rates go the wrong way, you can get yourself in trouble. So that's why I do believe a diversified portfolio is really important, and not to necessarily park all your cash or just purchase treasuries, because the inverse relationship or the indirect relationship with that asset classes have with respect to each other is very important for the long term. And also liquidity is very important for the short term. And so I would just be very careful of this idea of
price movement,
buying long duration assets with the high degree of certainty that rates are going to go down.
Yeah,
because I'm not sure that's the case.
Yeah, and I left it out. I mean, I have a lot of short-term T-bills, like 6-month to 1 year T-bills for that liquidity. But, this is money also that I don't need today. This isn't cash flow that we need for anything else. It's just, I got to put it somewhere. I don't want to put it in risk-on assets right now. I just don't believe that it's the right dynamic for that. So that's what I've done. And again, that's just my personal sentiment. But let's kind of get into the final thing. From 97 or when did your brother start the firm?
He started in the business in 91.
But One Wealth, when was One Wealth?
One Wealth was we started the business in 2015. So we left JP Morgan. We were at Bear when Bear was going down. We talked a little bit about that earlier. We stayed at JP Morgan from 2008 till 2015, and then launched One Wealth Advisors.
Did JP hold your assets that you had there hostage, or were you able to take those with you?
Yeah, so so the answer is yes. They held the assets of our clients, and so our clients had assets there. And then literally we left JP Morgan and had to contact every one of our clients to try to convince them to come back over to us. Yeah. So we started with zero.
So they played that game. Just wondered, because I did the same thing with a different large firm, which I mentioned, and they definitely played that same game.
I have to, and I want to go on record in saying I think JP Morgan is an incredible company. So I really feel that it's, of all the banks that I would consider working for, and I wouldn't work for one again, JP Morgan I feel is a really good company. So there was no ill will towards JP Morgan.
Right. All right. So you built this firm with your brother, and you guys did it, over this course of time, but you built it to 1.3. So, being in this space, there are these periods when you're growing. In the beginning, it's kind of you're just doing what you do and trying to get assets under management, build it. But you hit a certain level, and different businesses are different things, but let's just call it 5 million in revenue. You hit that. And then also at that point, you have to go back to your business and almost recreate all your infrastructure. Your CRMs need to change. Your processes need to change. Your workflows need to change. It's very labor intensive, cost intensive, and then you kept building. So how many times in this journey of 0 to 1.3 billion have you had to re-engineer your company systems, processes, and workflows to kind of sustain the growth that you are going to see in the future?
So I think of it more iterative, and I think of it enhancements, not recreating, right? And so in 1997, when we were cold calling, and we would get a prospect who then became a qualified lead, who then became a qualified lead after we met with them, and then after we met with them, they said yes. There were 4 stages of this person or family so when we were documenting all this, it was in a spreadsheet, right? And then at Bear, they launched a CRM, and we considered using that CRM, and then we kind of mapped everything over to that CRM and had our business development concept built into the CRM, and then we had our client meeting set up into our CRM, our service model. And then obviously when JP Morgan acquired us, we had better systems than Bear, so we considered using their systems. But all along the way, the process has been relatively similar. Our service model has been very similar. Our business development model initially was similar. We got to the point where we were by referral only. That happened around maybe 2003 or 2004. And that's largely so we could focus on our existing clients, who ended up being our best sources of business development by just doing great work for them. They referred us to others. But along the way, yes, I would say up until 2015, when we launched One Wealth Advisors, we were inheriting tools that were provided to us. And in doing so, they, the companies took half of our revenue as a cost. In 2015, we launched One Wealth Advisors. We used a company called Dynasty Financial for 2 years. They're a great company. I still recommend them for advisors who are considering moving from a wirehouse or a bank to independence. But what I would say is that, and then Dynasty kind of helped us bake our initial tech stack, right, and the tools, and they did a really good job of that. After a couple of years, we felt like we wanted to go on our own journey, rethink our tech stack, rethink our different systems and processes. So we didn't renew our contract with Dynasty, but again, I think they do a great job in transition. And so now it ends up being more iterative. And yes, we are past that $5 million revenue number. So we do have to rethink the resource allocation towards humans, towards technology, towards systems and processes. That, to me, is one of the most fascinating parts of this business, because one, as it relates to human beings, we get to employ human beings, and we allow them to have agency in our culture. So to me, you're talking about how to allocate resources at the end of the day. In my opinion, to me, that's the greatest blessing, is to allow others to help define culture. Hire great people, help them, allow them to define culture, and then also have a say in what our systems and processes look like. So at $5 or $6 million run rate, which is where we are right now, a little bit past that, $1.3 billion in assets, we are just, I feel, it sounds strange, but I feel we still feel like a garage startup, a garage band, trying to figure out our systems and processes. And the cool thing is, the tech world is coming to us, right? It's only getting better. And so the challenge that we have more than anything else is choosing the different technologies, tools, systems, and processes that we're going to use to make our clients' lives that much better.
I love that. Well said. And we're at about a 10 million mark right now. So we've had to go through that rebuild several times, and we're right there now where we're completely rebuilding all of our workflows, integrating AI into it, finding efficiencies to grow. And it is fascinating. It's also a pain in the butt, because there are so many options that come at you. It's just hard choosing what is the path. Do you build it yourself? Do you use, an integrated system that's already built and just kind of try to model it around yours? It's fun, but it's also, it's a bit stressful.
I love that part of the business. That to me is one of the most fit. And as an entrepreneur, like, to me, I eat that up all day long. I have a bunch of hats. Obviously, I'm the CIO. I have my own clients that I'm the relationship manager of, and I'm basically helping to operate I'm kind of in charge of operating the business as well.
It's a fascinating business, and all the more power to you to the fact that you've gotten to this point. It's just going to get better and better, and
appreciate it.
It's really hard to build an RIA to that point. The last thing I want to talk about, and you mentioned this, and I'm glad you did, but we talked about it offline, is when I asked you offline, hey, what is your call to action? Because a lot of times I want to make sure I serve you, right? I'm in the business of serving people. I want to make sure that, whatever it is you want to accomplish. And you said, there's no call to action. We just want to bring awareness to, One Wealth Financial and just what we do and how we do it. And I thought that was really commendable. So you're here just serving, you're just telling your story and everything else. But you also mentioned, there that you went strictly to a referral basis. So let's just talk, let's just say, out of the 10,000 people that are going to hear this episode, some of them are like, I got to work with One Wealth Financial. I really want to work with them. What are your criteria? Because it's important to know who your client is not, so that you always understand who your client is. So who is your client?
Yeah, our clients generally are nice people.
That eliminates 99% of the listeners.
We have a nice people policy, and the decision to work together needs to make sense for both of us. Obviously, there's nothing we'd love more to be able to serve every human being who walks in our door, right? And what we try to do is, independent of asset size or potential revenue opportunity or complexity, whatever it is, we try to at least give them a couple of nuggets that they can take away in conversation to potentially bring them better peace of mind, right? So who's our target audience? I could just say who has it been in the past. It's generally one of three types of clients. It's a family with some level of layers, whether it's working with parents, whether it's working with the kids of parents, and or the third generation, and sometimes even the fourth generation. It's tech employees, typically not C-suite. We focused on engineer to VP level clients. That's largely because we felt that those were the types of clients that we wanted to work with. Those are the clients who are willing to bring all their business to us. We only do business with the people who have all their assets with us, which typically leaves out the uber wealthy, the $100-300 million clients, because typically they're going to have multiple people in multiple locations. And like I said, nice people. We really, the types of employees we hire we're not hiring based on technical skills. We're hiring based on very high EQ, and we get to teach them the technical skills of the industry. Many of them got their CFP. I got my CFA. Some are in pursuit of their CFA. The technical skills we think that could be taught. The high EQ, the high, high touch, the love that we express and communicate and work with our clients is what's most important. So clients who are going to treat my team well, right? We very much care about that. We work for them. We know we're the hired help. There's no confusion around that, but like treat us in the same way that you'd want to be treated. So that's why I say nice people. Treat us like professionals. Treat us like somebody who you would want to be happy when serving them. Those are the types of clients we're looking for.
Wow, that's really good. Yeah, nice people. They are sort of hard to find these days if you're looking in the wrong places. Well, Jonathan, this has been really phenomenal. Congratulations on all your success.
Thanks. You too.
One Wealth Financial. And is that the website? Is it onewealthfinancial.com?
It's One Wealth Advisors, and it's onewealth.net. ONEWEALTH.net.
Perfect. Onewealth.net. We'll put that up in the description. So if any of you want to check it out. And Jonathan, thank you so much for your time.
Thank you.
Time is valuable. I appreciate you coming on the show. And folks, for every one of you listening to this episode, thank you for making it to the end. And thank you for joining us for this episode of Money School Elite.